What sense are you making of the current market activity at the moment, where there just seems to be too many unresolved issues at hand, deterring any sustainable upward momentum on this market?
Morning, Alishia. I think that it's fair to say that, this market is, in terms of participation, we see 50% from foreign investors on average and 50% from domestic. And I think we have to be careful not to sort of overanalyze things. Moving into the traditionally quiet summer months, we saw a lot of uncertainty on the international scene. There were resurgent concerns about a double dip, and in such an environment, markets like Nigeria, that are frontier markets, are not really first destination for investors. And on the domestic front, of course, the uncertainties have been well documented. But and then on top of that, we've moved into the summer, traditionally quiet July, August months. But I would expect that as we come to September and sort of Q4 towards the end of the year, when investors return to focusing on the market in earnest, the double dip concerns have abated. And I think that there'll be a new search for yield, and there'll be increasing interest once again in the frontier markets. As for the domestic guys, I think that the AMCON, as we know, has been a sort of a pending issue. I think that given that the banking sector is half of the market, volume and value, and has been consistently, it's hard to expect anything meaningful to happen within the market until there is a catalyst within the sector. And we've been saying at Stanbic IBTC for some time now that until there is an M&A deal announced, that kind of offers some tangibility to a lot of what has been happening with this reform process, it is difficult to expect sustained momentum in this market.
Well, that having been said, you do have your eye on quite a few of the stocks at the moment within that banking sector. So let's run through as many as we possibly can in the time that we have. Access Bank, of course, this is a bank that is still being expected to release its first half results. So how are you viewing that stock right now, and what are your expectations of its numbers?
Well, the Access Bank half one results, we expect them to be in keeping with, that which we've seen in the sector and other, indeed other tier two players. And we've seen among other tier two players, almost without exception, that the momentum in Q2 versus Q1 has been stronger. They have had a sharper drop in interest income expense. They have had lower provisioning, and income has risen sharply. And I would expect these things to also be demonstrated in the half one Access Bank results when they come out. Mm-hmm. But I think the key thing really for these players, particularly the second tier players, is that the current environment is somewhat unique, and it's probably not sustainable. So the question really is, how do they sustain cheap funding going forward beyond this sort of period that is somewhat unorthodox, and how do they find outlets for that funding that ensures that they sustain their margins beyond this low period of average cost of funds of 2 to 3%. And I think that the tier two players, the 4 tier two players that I would sort of group together, namely Sky, Access, Diamond and FCMB, have a fairly different approach to doing that, and it's monitoring how well they execute that is key.
Yeah, what's interesting when it comes to this player is that, many saying that these results is as simple as them expecting to keep with the market trend that we've seen emerge. But when it comes to Access Bank in particular, it's playing a very different strategy in that it's not trying to compete with any of the first tier banks at all. So run us through that strategy and what you're making of it, that it is happy as it's as a second tier bank right now.
Actually, I would disagree with that. I would say that of the 4 banks that I mentioned, Access Bank is probably the most ambitious in that regard. I think that the current developments within the sector offer it an opportunity. It has always asserted that it is focused essentially on the corporate market. Now, with a number of former tier 1 players having difficulties, it has the option of having that game-changing sort of season, either by undertaking M&A or by pushing aggressively for organic growth. Now, I think that of the 4 banks that I mentioned, Access Bank is probably the most inclined towards M&A, even though I would say that I don't think it's necessarily a do or die affair for them. But I think they're confident that if they decide to do a transaction, that they can execute it well. So I think that I would expect to see them pushing hard in the corporate space, and also, you know, interestingly, we've seen that they have sought to secure term deposits, which is something that we have not been seeing in the market. The half-one results should indicate how they have fared in doing this, and I think that given that they're not pushing into the retail part of the market, the idea of locking in relatively low cost funding over a sort of one-year period for them is seen as you know, the alternative to doing that. So it'll be interesting to see how far, you know, they have fared.
Really, my mistake.
And this is
with
quite
all the
different
banks in Nigeria, I'm mixing my banks up here. It's got so we've got that on the agenda with Access Bank, but then Diamond Bank is steering away from that kind of strategy, right?
Yes, I mean, Diamond Bank has, I guess, always asserted that it is more focused on the sort of middle tier of the market from the corporate end, and we've seen it pushing aggressively, increasingly into the sort of retail space, retail SME, the lower end of the credit curve. Now, obviously, you can lend in those segments at higher margins, but you know, you have to, in order to maximise your returns, again, the issue of low-cost funding, which is something that they are enjoying as a result of the current market situation. But in order to sustain it, they are working on pushing into the retail space with direct sales agents. They are ramping up considerably on that front, and we're starting to see a significant change in the mix of their deposit funding. So relatively expensive term funding is reducing, and the demand deposit element is on the rise. But you know, it takes time for this to sort of really gain traction, and you know, seeing how this plays out during the rest of the year, you know, the second half, is key to sort of determining whether this kind of chosen path is a sustainable way of maintaining their net interest margin.